Ladies and gentlemen, welcome to the Midday Market Monitor. In today's video, this is actually our last live stream of the week. I won't be here tomorrow, so apologies on that. Prepare your schedules to be a little bit different. However, we have an exciting day to round out this week as we will be live streaming about a lot of very important companies. We have an extremely exciting interview today, one that I am, just very pleased that they're willing to come on the show and share a little bit about the company that they work at. That's the thing. Not a creator, not an investor, an employee of a company that we've been following. Hopefully everyone is doing well, even with the even with the S&P 500 a little bit red. NASDAQ actually turned green here, up only 0.2%, but a little bit of green candles. The market knew we were about to go live, so they're starting to buy back. It's time to go green now. And soon the S&P needs to follow. Leading the charge today is Chime Financial. Chime is up 27.5%. This company was a trade for me. I'm feeling pretty confident to say that I'm likely to completely sell out of this name and, rotate that into stocks that I believe will be a little bit longer lasting. And we can go through an entire review of Chime today to talk about why I believe that they're doing amazing, that the company was extremely undervalued before, but now as it's starting to approach, more than double where we ended up entering into this stock. The first time we bought in or really bought in was about $16.50. We literally bought the bottom what was probably almost a year ago now. It's been a little bit of a hold. I was expecting some good results from Q1's earnings report, but we really ended up seeing a lot of that gain come in Q2. Now, like I said, we'll be reviewing that. Guest comes on at 2 p.m. But just to highlight as we go through Chime and talk about this business, they are a financial technology firm. They think of themselves as more of a Silicon Valley company that is tackling financial services, not necessarily a bank that is entering into, the tech side. So very much on the SoFi side of things, new bank type thing. Take a younger, fast-growing, young tech company that is trying to tackle some of those problems. Let's go ahead and listen to their CEO and founder, Chris Britt, talk about their report here.
Welcome back. Financial is one of the best performing sectors this quarter after a number of reports showed a surprisingly resilient consumer, including those from our next guest, whose shares are now seeing their best day ever, up almost 22%. Chime CEO Chris Britt joins us this morning, first on CNBC to break down the numbers. Chris, good to have you. Thanks for the insight today.
Great to see you, Carl.
Stock's getting re-rated here. What do you think it's about?
Well, I'm really proud with how the team executed this quarter. We grew our top line 27%. We continue to show operating leverage in the business. We achieved 15% adjusted EBITDA margins. We had our second quarter of GAAP profitability, and we raised guidance for the next quarter and for the full year. And I think it's really in large part due to the increasing velocity that we have here at the company, our products like Chime Prime, which are really helping to drive the growth and the success that we've had.
Do you think it's about execution, or is there something about the macro backdrop that's making this easier?
Well, there's no question that if you look over the past year, the rate at which we've been launching new products has significantly accelerated, from Chime Card to Chime Plus to Chime Prime. We just launched Chime Invest, and we have our Jade AI Copilot that's just a whole host of really exciting products and services for our core members. But it is true, if you listen to the earnings from other banks and a number of other CEOs that have been on CNBC the last week, you're hearing that the strength of the consumer is actually very broad-based. So some people are challenging this notion of this K-shaped economy because people across all income segments are actually demonstrating a tremendous amount of resilience. And we certainly see it in our portfolio with spending up, savings balances up, and in general, it just looks like people have confidence based on the behavior that we're observing.
That 10% workforce reduction that you announced, Chris, I know on the call you framed it as a position of strength, but how much did AI contribute to a reduced workforce?
Well, it's incredibly painful when you have to make changes and it impacts individuals and personnel that have done so much for our company. But what we're seeing inside of our organization is that smaller teams with fewer layers and clearer accountability are getting more work done than ever. And a large part of that certainly is AI as an enabler. We have, development teams that are half the size that they used to be, sort of in the old days, the way software was typically created, and they can do just as much work, if not more. So AI is certainly part of the story, but I wouldn't say it's entirely AI. Part of it's just the natural evolution of a company. As we grow and scale, we want to make sure that we're eliminating bureaucracy and removing layers and making sure that we're holding on to that sort of entrepreneurial spirit, which has really got us to this moment and place that we are now.
Yeah. So, I mean, I even see a comment here in chat that I want to highlight really quickly. Chime is doing what SoFi is not. Now, let's go ahead and review this quarter, talk about what we ended up seeing, because it was a good quarter. You don't see a stock go up 28% on bad earnings. But to say that this is, to be compared to SoFi and that automatically because of the stock reaction, that this means that they had a better quarter than SoFi. And we can compare them one-to-one. It's not really what my review is about. But let's go ahead and jump into a review on Chime's Q2 2026 earnings report. So for many people that don't know this name, maybe you're not in America or searching for a new fintech name. If you are, this is likely a name or logo that has passed you by, because this is a new everyday checking account, debit card. They're starting to branch into new products, which we'll talk about here in a second. But for the most part, it was an easy to access checking account online that offered good rewards and good services for the average American. Now, as Chris Britt just said in that interview, they are trying to promote new products like Chime Prime that go after users that are making more than $75,000 per year, right? So leaning into the little bit more affluent stages, offering credit cards, offering Chime Invest to allow people to invest their discretionary income. But let's go ahead and look through some of the products that they do offer already. So you have things like instant loans, fee-free overdraft, low-cost earned wage access, high-yield savings, up to 5% cashback rewards on your spending, right? There's a lot of great styles for, the people that don't have extremely complex financial lives. You can get, 99% out of what you need from Chime's, what looks like more and more holistic services. Now, there's really two segments that we want to break this down by. You have the liquidity products like SpotMe, MyPay, and instant loans, which is essentially overdraft protection, getting payroll, deposits a little bit early, and then obviously getting access to a little bit of money as well if you needed to buy something right away. Now, you can see this immediately where it says average transaction size. SpotMe is a $20 spot. Like they are talking about overdraft fees for $20 deposits or $85 direct payroll access just a little bit earlier, or even instant loans. The loans that SoFi gives away on their personal loan side on average is about $26,000. The instant loans of Chime is about $200. This is a very, very different type of consumer. The average person that is taking out a personal loan at SoFi is roughly about $150,000 or $160,000 of earned income per year. On Chime, their higher end of user is $75,000. The average person is actually lower than that. So this is tackling a different user base, and they're not necessarily marketing themselves towards the same user. Now, whenever you go ahead and you look at, the United States total addressable market, more than 200 million people fall into the category that Chime is trying to promote, whereas the people that SoFi really tries to promote towards is a little bit more affluent, less of a total addressable market. Obviously, they still have tools for the everyday American, but they really try to build their recent products, student loans, home loans, personal loans, credit card offerings, all of the debt solutions that you might need to somebody that's earning just a little bit more than maybe the average Chime user. Now, Chime doesn't break down their members via total members the way that SoFi does. SoFi and Chime, you can't really compare one-to-one because Chime does active members. This is somebody that's made a revenue-producing action within the last 30 days, which is still climbing up. But whenever you compare the member growth between a company like SoFi growing roughly 1.1 million users and Chime growing about, 200,000, it is a little bit different. But a lot of that member growth actually came the quarter before. So it's really good that they're holding up those amount of active users, but a lot of the growth has come previously. And, maybe we end up seeing higher amounts of overall user growth between the December and March updates like what we've seen in 2024, 2025, and 2026. Now, whenever you're actually looking at the revenue that this company produces, they're growing at about 26.8%. which is higher than what they guided towards, and they beat their revenue expectations. So they did $670 million. That, as we talked about, breaks into two different segments. You have the payments revenue, debit cards, credit cards, interchange revenue. That's where they saw the bulk of their overall revenue before. It still is the bulk, but obviously there's this other segment, which you can see in the green here, that used to grow at hundreds of percentages, now growing at 48%, which is really the Spot Me instant loans, the sort of benefits where they're making anything other than transaction-based revenue, okay, which is growing much faster than the transaction side. As you can see here, purchase volume did take a big tick up, 17% year over year, really good sign. But as of the most recent quarters before that, that growth obviously has been falling over time. It's not growing as fast as their total user base is growing. So while you have revenue growing, a lot of that new revenue growth is coming from the new products that they've been able to put on the platform, like MyPay, for example. MyPay has been an extreme success. Not only has loss rates completely dropped off a cliff and actually fell below their target of 1%, they did 0.9%, which was better than the company's long-term expectations, but the transaction margin has more than doubled over the last year from 30% to 64%. And the average, sort of MyPay transaction profit, or not average, but the total for the quarter has gone from $23 million up to $73 million quarter over quarter. That's a 3x in just a year. So MyPay is doing extremely well. And it's that, small fee for service for actually taking, payroll transactions just a little bit earlier. Gross profits, because a lot of this is interchange revenue, is staying extremely high, roughly 88.8%. Very, very high for a financial services company, but a lot of that is payments. So it's more comparatively to a company like maybe, PayPal or, an Adyen or something like this that is more in the payment side and interchange side. Now, even whenever you look across their business, they are getting better over time in terms of their cost to serve going down, roughly dropping about 35% over the last 4 years, whereas the average revenue per active member, or RPAM, has gone up 24%. Both of those are extremely good signs over the last 4 years, but obviously, average revenue per active user, I think some people had expected it to be a little bit higher over the same period because their fastest growing users are in that 75,000 range. One of the things that they talked about is to try to attract that new style of user, you have to give more in order to get more. And so if we go back here, you can see up to 5% cashback rewards. That's in a category of your choosing. So you're going to put that into a category like potentially travel, gas, restaurant, something like this, of wherever you're spending the most. These are large expenses to them. And so expenses are dropping over time as a percentage of overall revenue, but it's maybe not as fast as other competitors have been seeing in the same time frame. Regardless, operating expenses are falling, another great sign of a public business, and this company is just starting to turn profitable. Now, what's throwing this off here is the year-over-year comparison of losing $900 million in June, but that was really a GAAP metric. They didn't actually lose $900 million. That's just when they went public. Okay, so you're having some of those stock-based compensation expenses, some of these things that are really showing up here. The part that I wanted to show from this chart, though, is that we've seen 2 quarters of real profitability. And if we see 2 more consecutive quarters of profitability, this company will actually start to see a price to earnings ratio and be compared to the SoFis and, blocks of the world to compare it against Cash App or other areas that are really competing with them. Now, this metric I included, but it's not exactly super clear just because it is a financial services firm, but free cash flow is growing as a percentage of overall revenue. And they did bring in roughly $97 million of free cash flow this quarter. Although the company just went public a year ago, they're already in buyback territory. They IPO'd at a terrible time for Chime when fintech companies and the macro backdrop completely switched. And so Chime's stock completely dried up whenever it came to interest in new fintech companies. So the company immediately took a lot of their profit that they got from the IPO, turned around and started to utilize that towards buybacks. We really saw that hit a big high here in the most recent quarter as the company hit new lows in the past quarter between March and June. And so they put about $136 million back into buying stock. You can see where they were doing that right about here. Okay. For reference, I bought into this company back around November of 2025. So we've held through a pretty good appreciation of the stock, reselling, and then a really good spike up, but nothing compares to where they IPO'd at whenever people were really excited about the IPO market and they got paid a ton of money and wasn't actually a lot of dilution, but this company quickly corrected to its comps. What I mean there is that whenever they IPO'd, they actually showed off to be very, like a way higher multiple than companies that even like SoFi, for example, with less members, less revenue, less profits, and slower growth and lower margins. That's not really a good sign to keep a company really high valuations in very similar, comparable markets. And so the company immediately regressed during that period, and SoFi stock actually accelerated since their IPO. So the valuations have kind of flipped. Chime is now the much cheaper company and SoFi the more expensive business. Now, whether or not that should be the case, I mean, there's a bunch of sort of KPIs that you can point to say this company is headed in the right direction. Average revenue per user climbing up to now $260. And that just a few years ago was obviously much less than where we are today. They've launched new products, and the more products that people start to take on, well, obviously, average revenue per user is going to climb up. Mind you, they're still not done with improving their product roadmap. They want to do subscription management. They want to do Trump accounts, joint accounts, line of credits for different people, and budgeting, which would go right up against SoFi's Relay product. And you can see the more products that people attach over time, the higher that the average revenue per active member is going to climb. And for the more mature customers who have been on their platform for longer and longer periods of time, some of these are earning as high as $400 for customers who have been around for 2.5 years. So the longer you stay on this platform, the more money you make. Very similar to Nubank and likely very similar to SoFi, but SoFi doesn't really show off these types of metrics. Now, Chime did say that their fastest growing segment amongst their consumers were the ones that were making more than $75,000, which is their sort of higher end of customers that are coming on the platform. And so offering this new Chime Prime product has actually been a really good attach rate, and customers are willing to give at least $3,000 of direct deposit per month to actually unlock that new ability. Now, with all of these higher attach rates for new products, which people then end up coming back and signing up more products and are not churning off the platform, even though, Chime has probably some of the higher churn that you would see versus other fintechs, but it's still, very good, is that you see that they have very low customer acquisition costs, about $100, and that the lifetime value of a customer comes in at roughly $1,900 per customer. Active member churn in the first year is 50%, which is quite high. But after that, the customers that can stay past that 12-month period stay for a long period of time. And their lifetime value or LTV to CAC, which is really good in the sort of 3 to 5 times range. That's like exceptional at 5 times. Chime's LTV to CAC is roughly about 9.2 times. Okay. So extremely strong if you were to play this company out over long periods of time, that they would make way more than what they're throwing back into sales and marketing. So they can play that, story out over and over and over and would be able to raise more money, and banks would be happy if they saw this type of LTV to CAC. But the most important part is raised guidance. Chime ended up raising their guidance versus expectations, not only for Q3, which got raised, but for full year also got raised. Okay. But we still have to put into perspective that their growth is expected to be at 25 to 26% and adjusted EBITDA margins of about 17%. Whenever you talk about companies like SoFi, in that comment that we highlighted earlier that says Chime's doing what SoFi is not, well, you're really highlighting against a company that's growing at 40+% rates that wants to grow EPS at 40+% rates over the next 3 years, and adjusted EBITDA margins were above 30%. So they're growing not quite twice as fast, but much faster than Chime on higher and higher margins. So I wouldn't necessarily say that there's a correlation between just because this stock has seen a single day of high percent movements, that means that this is an overall better business for the long term. The longer I see companies that end up going public, we used to point to Chime and say, oh my gosh, what are the metrics on this business? Now that I actually get to see it, it gives me more belief that SoFi is the one that's actually winning over whenever it comes to churn not being 50% in the first year, customers taking out more products and staying with the company longer, taking out higher value products and being a little bit more affluent, which can affect loss rates during extremely bad periods. This is another thing that I want to highlight. People worried about sort of a credit crunch whenever it comes to SoFi or Chime or some of these businesses. Now, Chime doesn't do a lot of credit products, but as you can see from their product roadmap, getting into lines of credit and these sort of things, they are headed towards that direction. Every company in the financial services area will want to become a holistic one-stop shop. Just SoFi was the first to say it. But as you end up saying that you want to be a holistic business, credit is going to be a big part of your overall revenue, future. And as that happens, if there is another credit crunch or a 2008 sort of concern where people start to really default on a lot of their loans, the first area to get hit is usually the lower rungs of the credit spectrum. People that are not earning as much and not paying back their loans quick enough, right? SoFi is a little bit insulated in that because you're taking out loans that are prime plus. They're better than prime loans. And so it's the subprime that really takes the hit first. And you really do get to see a lot of that whenever people are taking out instant loans of $100, $200, or $300. That's usually the area that suffers first. So I like Chime here, and I was a shareholder. Well, to be fair, I still am a shareholder, but I'm going to be looking to sell out of this position to buy probably more SoFi as this company stays lower, or potentially rotated into other areas like artificial intelligence, as I think that there's better opportunity than this company that was undervalued. But in the long term, over the next 10 years, I don't necessarily think that it's going to be a bigger brand that a company that is growing much faster on higher margins will be able to achieve. Hopefully that sort of clears up my stance on Chime right here. But yeah. Okay. Let's go ahead and check out the markets really quick. Chime, like I said, up a ton, up 27%, but that's really because it was extremely undervalued. Not necessarily, that we're seeing some paradigm shift or something like this. Guidance is increased. They did really good on the top and bottom line, but guidance is not getting corrected saying, instead of seeing 15 cents of EPS, we're actually going to see 45 cents. It's more like instead of 15, we're going to see 16. All right, it's good. Happy that they continue to compound, but yeah. Tanner's a buy low, sell high type investor. I mean, that's the hope. Now, to be fair, Chime was never a long-term hold. I said to everyone at the time whenever I bought it, that this company is undervalued and that there might be an opportunity to see this company recorrect to fair value. And I think that's what today really ended up showing. Not saying that the company is going to do bad over time. I just don't know if we're going to see better than, S&P 500 gains over the next 3 years whenever the company, and I mean, we might. I mean, a company's growing at 25, 26%. That's great. But let's not neglect the fact that there are companies growing at 40% that are also being neglected in the stock market right now. What's going on with Nebius? I think I just saw a comment in chat saying that Michael Burry is shorting the company, but I don't have guarantees on that. Let me go ahead and see if I can find this. Okay, Michael Burry did just post. He talked about 2 new shorts. There's a quote here: "The fish has gotten very fat, very large, easy to shoot. Also, so large that it shan't be long before every last one kneels over from a lack of oxygen. In any event, I came across the inconvenient truth." Yeah, it does look like Nebius. Uncommenced leases, some as long as 11 years, at 18x the company's entire sales. This is not the only one of this kind of problem excused in the present as simply future growth, but it's misinterpreted. Yeah, that sounds like Nebius in terms of signing deals that are larger than their current sales. He shorted Nebius and shorted Oracle. Okay. Shorted Nebius in a large, this is a very large short for him, and he took it out at $211.77. He also shorted Oracle at $144. Oracle actually staying flat on that, not letting him win out on that trade just yet. We'll have to see if that holds true, but very interesting, the Nebius short. SoundHound, I got to review this earnings. They popped like very, very big on earnings, up 11.8% now, but this got as high as $8.30 in the pre-market. I want to look at that. I've sort of brushed off SoundHound, not really knowing what they're doing differently to their competitors. And whenever I say competitors, I mean literally the large language models. What is SoundHound doing that an OpenAI cannot do? Zoom out on SoundHound. I completely understand. I get it. Okay. I do. I think there is a possibility that companies that have been considered dead can come back. I don't know if that is SoundHound here. But essentially my understanding is they've signed deals with companies like Wendy's, for example, to offer voice to AI for like menu ordering. So then you don't need somebody taking the order over the speakerphone. I think they do this across many different sectors: finance, hospitality, all of this stuff. But it's like, will Google not be able to do this? Will OpenAI not be able to do this? Who knows? What are your thoughts on Nebius earnings? I didn't even see. Wait, no, Nebius earnings is next week, right? Isn't that next week? Yeah, it's next week, Wednesday. We also have CoreWeave the night before, and Lumentum, and Supermicro. So this is like, next week is going to be a huge week for my portfolio. Very, very big. We also have dLocal. Wow, dude. Okay, wait. Let me share my screen. Next week has like a ton of names in my portfolio. We've got Nebius, CoreWeave, Lumentum, dLocal, but I still think it's very important for me to follow the names of Rocket Lab. Obviously C Limited will be very big. eToro will be exciting to watch. Coherent, Cerebras, maybe Ondas as well, and Figure. And there's going to be a lot of very interesting names next week. But yeah, I even have SMCI in my stock draft versus the boys, which we're still first place. Only me and Matt are making money in this market, but not much. It's been a hard starting point. So we started on, I think it was June 18th. So the markets have been extremely choppy since that point. Jason's portfolio almost down 17%, Amit down 15.5%, Chris down 11%, Steve, very, very big difference between the bottom three and the top three. Steve only down 0.7%, Matt up 0.3%, I'm up 2.1%. And you know what? I don't think in You know what I think I'm benefiting from is that I didn't really take too many extremely optimistic companies. Like I didn't make any Hut 8 bets or like extremely aggressive bets whenever it comes to the artificial intelligence trade. I didn't make extreme bets on the software side. You know, I sort of took the middle ground on all of these in terms of betting on businesses like Microsoft. Now there was SMCI. Like I definitely do have some high risk names in there. Lumentum's another one, but Lumentum could show out. We could be really surprised by their earnings overall. We'll have to see. How can SoFi be down to flat and Chime up 30%? Well, Chime was way cheaper than SoFi. I mean, they were extremely oversold. That's why I bought them. You know, but that doesn't mean that long term that they win. Yeah. Tanner, can we have Jesse on more often? Yeah, Jesse's going to be back for sure. You know, he's got to get his own swear button, but no, I love Jesse. My goal is to get a very, very wide range of guests on throughout the next, well, you know, for the foreseeable future. But I really like this schedule here that we have. By the way, I'm not going to be listening to the earnings tonight. Airbnb, Trade Desk, there's nothing really that I want to hear too much about. I was actually a long-term Airbnb shareholder for a while. Turned out to just be opportunity cost, and who knows, maybe this is the time where it pops. But I think that there was a real movement happening, and not saying that it, you know, the movement's still not happening or whatever. Like obviously they're like an extremely big company. But I even sort of saw myself just going like, okay, do I want an Airbnb? Super expensive. Or if there's a hotel, I actually think that service is way better than having an Airbnb where, you know, quality control is maybe a little bit less judged than, or a little bit less consistent than maybe a hotel is. So I actually prefer hotels myself, but obviously the flexibility of Airbnb is still nice to have. Now, Cloudflare is going to be super interesting to listen to, and maybe we'll stick around to like 4:15 to just hear the numbers. But I don't think I want to listen to any of these calls. AOI might be interesting. Cloudflare might be interesting. The Trade Desk, I mean, nothing would make me happier than this company coming back. Not that I benefit at all. I'm not a shareholder. It's not in the draft. It's nothing but like, yeah, I don't know. I love Jeff Green, the CEO. He's amazing, but yeah, the company has fallen apart recently. Absolutely fallen apart. Atlassian's there too. CleanSpark, Monster, Sezzle, Texas Roadhouse, Dropbox. There's a couple big names in here. Five9, Corsair. Yeah, I'll stick around, see the numbers. DraftKings could pop because of World Cup, but how much of that is already anticipated? I mean, who doesn't know that they're going to see increased amount of volume? Shift 4, yeah, Shift 4, that was the nail in the coffin for me. You know, this really goes to show you, I think if there's one big lesson that I already knew of, but it's so important to, whenever you hear that the founder is leaving, and you can hear that they're still, you know, they take the phone calls, they do all this, they're still putting new money into the business. That's what threw me off with Shift 4, where I thought maybe it'll be okay. Taylor Lauber's a great manager of the business. He's been in Shift 4 for an extremely long period of time. But it's just different than having Jared Isaacman at the helm. And so I can't continue to hold this business whenever there's so many fantastic companies that I'd rather hold. Shift 4 has been a disappointment. I'm actually taking a loss on this name. I think my average was something like 59, something like that. So not good to have to sell out of a company that, I've championed for so long, but that's the investing game. I'm sure I'll be used, people will throw that trade back in my face and say, hey, how should we listen to this guy? He's got something wrong. But I think it's important to not champion a company all the way to zero, and that whenever the thesis changes, that you pull out while you still have time. I think the real opportunity is, if you can sell out of that name and put it back into something else. Let's imagine that, Shift 4 ends up seeing a shift and ends up doubling. Well, what happened to your money that you rotated that into? For example, Tesla ended up moving up since I've sold it, back in 2025 or whatever, but NVIDIA had moved up way more. So that was a successful trade. Obviously, I didn't sell it at the absolute high for Tesla, but NVIDIA obviously had made more money, and the trade was mathematically the right decision. But yeah, it's the ghost of PayPal for me. It happens, but hopefully you make 5 of these trades and you only need one Nebius. You only need one company to go from 80 to 211. And that pays back all of the losses of being down on a company by 30% or something like this. Like, I'm not, it sucks. It sucks to lose on a name, but then, you look at the rest of the portfolio and Google's went from 140 to into the high 300s, Amazon's up. Nvidia's up. Shopify's up. SoFi, surprising or not, you guys make it out like I've lost a ton of money. I'm up like more than double. So, yeah. Okay. Why is Nebius down? Michael Burry is shorting the company. But you know what Nebius needs? They don't need bullish news. The bullish news is that the build out is happening. You can look to SanDisk and NVIDIA and all of these businesses that say the build out is still happening, and that's your bullish news. What you need to make sure is that customers are continuing to pay back their, the agreements that they ended up buying GPU leases from you, and that you increase. By the way, they don't even need to increase their ARR, their annualized run rate of revenue going forward, which should be recurring revenue for them, but that they continue to increase it like they have in the past quarters. So it just comes down to execution, right? Are customers showing up? Are you finding new data centers? Are you finding new co-locations? And are you signing new deals? And you don't need a big Microsoft deal or Meta deal in order to find much, like, I don't know how many times Arkady has told us that, like, that is not even the deal that they want. The real deals, the high margin deals, comes from the small business, the recently funded new company that is trying to train a new model to tackle e-commerce business or something new that they want to make a small model for. And they're using Nebius because it's a full stack solution. They have the tools necessary to run all of their AI workloads. That company on a per GPU basis is going to pay much higher than the Microsofts and Metas. Now, the reason why they haven't turned away the Microsoft and Meta deals is because those companies co-sign and do huge prepayments for the future growth of Nebius. So they're not just choosing the big names and they're not just choosing the small names. They're doing a mix of both to take the, sort of investment grade nature of a Meta while also taking the high margin nature of the, Mistrals of the world. And so those two together actually create a really good business for Nebius. Really, really good. But over time, they should bleed more, like a higher percentage of their revenue should come from the smaller and smaller customers, because that's how you get to hyperscale, nature. CoreWeave doesn't even really have they do have the possibility in the future, but the way that they're building today is not to go towards the smaller customers. They're building large clusters, mega clusters for the biggest companies in the world. But those are the companies that, while paying CoreWeave right now, and it might be advantageous, do have the capabilities to not only build their own data centers and build their own custom silicon, but also fund it themselves and do all these sort of things. So they have the technical expertise. The build-out's just going so freaking fast right now, so much bigger than anyone anticipated, that not only are they building for themselves, but they're also utilizing other companies' third-party data centers as well, just like what Google said in their most recent earnings call. So going back to it, there's a space right now for CoreWeave, of course, and maybe they end up shifting into more of a spot price GPUs, smaller clusters, virtual machines, all that sort of thing. But Nebius is future-proofing themselves to be more like the Microsoft Azure's, Google Clouds, AWS's of the world, where they handle every single customer's concern at any size. Why is Nebius targeted? Well, I would say that he's targeting neoclouds, and Nebius has a much larger premium than the CoreWeaves of the world, and that premium is given to them because of some of the metrics that we've seen in terms of lower amount of debt, higher amount of prepayment, majority stakes in businesses like ClickHouse. But if you're Michael Burry, you don't care. You don't care about any of that. You don't believe in the build out. You think everything is overblown, and so it doesn't matter if Nebius is overblown or, they have stakes in ClickHouse, because if Anthropic is too expensive, then ClickHouse is too expensive. So it's not just that Nebius Group is going to go down. All the subsidiaries they think, or Michael Burry thinks, is essentially going to be re-rated. That would be my understanding. And Oracle, he shorted as well, because obviously they have a ton of debt. Why CoreWeave wasn't involved? Maybe I think the multiple on CoreWeave has gotten pretty cheap, but I mean, honestly, he could probably end up shorting CoreWeave as well, because it would kind of fit into that Oracle-like short them because they have too much debt and they don't believe the customers are going to show up to pay. Maybe it's customer concentration, though. Oracle has major customer concentration in OpenAI. And CoreWeave does have OpenAI as a very large customer, more than $10 billion, very, very large customer. But it's kind of even with Anthropic and Meta and a lot of big names like that as well. So they're probably not likely to all not pay, but who knows? I guess it depends on how bearish you really are. Just bought Nebius at 200. Am I cooked? No, I don't think you're cooked. And I say that like, I'm not offering you guarantees. I'm just saying I'm holding it right here. So just by sheer nature of me also being an investor, no, I don't think you're cooked. Okay. Is Oracle not a hyperscaler? I think a lot of people do consider them hyperscalers, but hyperscaler is kind of like a fluid term, I don't think there's a genuine benchmark where a company comes in, they hand you a trophy and say, you've hit hyperscaler status. I think some people look at it as gigawatt plus. They look at it as full stack solution. But I think in either one of those perspectives that Oracle does fit the bill there. They're just obviously much smaller than the big three. Okay. Let's see here. Tanner, still surprised you haven't picked up a cybersecurity stock like CrowdStrike or Palo Alto. AI will only make them more necessary. I love the cybersecurity names. I put them in the draft because I believe in them. But I also think that, how obvious is that trade? How many people are buying into companies like CrowdStrike because everyone knows that it will be a bigger business in the future, and it just continuously compounds at that 20-30% level. And so I think that there's aspects of these companies that look expensive, although, it's probably worth it to some degree. Sentinel-1 has been a great buy. That one I would not touch. I'm more of a buy the best. If I was to look to buying a cybersecurity name, really the only 3 names that I've really taken seriously is CrowdStrike. Well, actually 4. CrowdStrike, Palo Alto, Rubrik, and Cloudflare. Those are the 4 that I've really looked at. SentinelOne, every time I look at it, their earnings are worse than I expected. I'm sure Zscaler's on that list too in terms of being really, really good. But I just don't follow the industry that well. So don't take my word for it. That's what I've heard. And I've also heard like a lot of, in terms of Sentinel might be an acquisition of like, also, why have they not been an acquisition? Like, if I remember correctly, CrowdStrike dropped the ball. What was it? It was some sort of hack or something like this. They dropped the ball. You know, they offered people like Uber gift card, like $10 Uber gift cards and stuff like this. Like the fallout was crazy. And it really goes to show you how good their products are because the retention levels on their customers were extremely high, way higher than I think anyone anticipated. And SentinelOne really got a big boost in their stock because people anticipated that if you're not going with CrowdStrike, that they're the obvious number 2. And they really didn't capitalize on how big of a screw up that one of their biggest competitors ended up seeing. So I think that expectations on SentinelOne have been less than desirable. That's my understanding of what happened. But people who are actually in that industry can tell me a little bit different. I'm not following it too closely. Caused Microsoft a blue screen on updates. Yeah, it was some. You're right. It was some update, something like this. Time flies. I remember that was such a big deal, and now I can't even really remember what the story was. Okay. Let's see if there's any CNBC stories. We've got our guests joining us here in a little bit. We have to worry about this consumer because it's weakening. Uh-oh, we got to hear. Chime literally just came out. They said the consumer's not weakening. They said consumer is extremely strong. Let's see if this poses a difference.
So far on Wall Street as the Dow pulls back following that record close. Actually, a couple of them earlier this week. NASDAQ a tick higher. Major averages all pacing for gains on the week. Joining us with her outlook for the rest of the second half is Man Group Chief Market Strategist Christina Hooper, who joins us here at Post 9. It's good to have you back. Thanks for coming in.
Thank you, Paul.
So we've talked throughout the course of the year. You've been on the lookout for signals of vulnerability, and we did get a bit of a gut check in July. You think there's more of that to come?
Absolutely. I think what we've seen is a U.S. economy that has been driven really by 2 key factors. We have AI, CapEx, that juggernaut, and of course, high-income consumer spending. And there are vulnerabilities with both. I think about AI CapEx and how investors are now punishing companies that are spending a lot. I mean, the conventional wisdom had been the bigger risk is to underspend rather than overspend. That's changing. And I think there are a lot of other forces pushing back on data center buildouts, like not in my backyard movements. So there's a lot that could go wrong in terms of not ending AI CapEx spending, but slowing it down from the levels it's at.
So when you think about potential sources of weakness, second derivative on CapEx,
Absolutely.
Rate hikes, or a weaker consumer, is it mostly about the CapEx story?
It is primarily a CapEx story, but we absolutely have to worry about the consumer because the consumer is weakening. As of the third quarter, according to Brookings Institute's model, we are net negative fiscal stimulus. And the fiscal stimulus we've gotten has been a lower multiplier effect fiscal stimulus. Then add to that the fact that we're taking on more debt, and we're just awash in debt in general, given all the AI related debt. And so what we're likely to see is a pretty significant increase in yields. Historically, yields going up have had a negative impact on equities, have depressed equity prices. So there's a lot that could go wrong in the second half.
So you think the Fed does move in September, and by how much?
So I think the Fed will move 25 basis points in September, and we'll probably get one more rate hike in the back half of this year. But I think the bigger issue is going to be rates on the long end and how much they're likely to go up. There's a lot of concern about fiscal sustainability, and that is not going away with the kind of deficit we're running.
Yeah, the long bond added, I think, how many basis points in July? 30 some odd basis points, which was the most going back to 2024 or so.
Absolutely,
right?
and that could easily continue. I think that's a very, very likely trajectory going forward.
How does the rate hike idea from you square with a weakening consumer? Wouldn't that tend to depress prices or at least bring in some disinflation?
Well, it could, but keep in mind that a lot of the inflation we're seeing is actually not being driven by demand, but it's being driven by supply shocks. Yes, demand as it relates to AI CapEx, but the rest is supply shocks. So rate hikes are not going to be as effective in reducing those prices. And so I think we have to just keep that in mind. This could be an environment where we get mildly stagflationary, which is always problematic for a central bank in terms of figuring out what tools to use and how to manage it.
Just digging into the AI CapEx concerns you raised, how does that really manifest? Is it just underperformance in the hyperscalers, more credit concerns brewing? Because I would point out just in the last week, spreads have tightened for tech corporate bonds.
Well, and I think we could go through periods where they do tighten, especially if we get a few hyperscalers that do report positive earnings or have some kind of positive outlook. But I do think that hyperscalers will be the epicenter. I think there are a lot of parallels with the late 1990s, early 2000s with the telecoms. They're the ones that took on the debt. They spent a lot of money building out fiber optic networks. Ultimately, that was a real positive for the overall economy, but many of them were left holding the bag. So we could certainly see that. Also, semis could be under some pricing pressure. I think where we're likely to see opportunities in the AI food chain is going to be those companies that can provide solutions that make it easier for data centers to continue the build out. Like, for example, more efficient use of energy, more efficient use of water, since that tends to be two of the biggest gripes that many communities have as they fight the build out.
Yeah.
A weakening consumer, eh? People don't want data centers in their backyard. That one I don't understand. Like, I understand nuclear reactors or something like this, but why the data centers not? Like, I would completely, without hesitation, live next to a data center, let alone where they're actually going to build it, which is going to be like 20 miles away from my house, which not necessarily that I'm saying there's any plans there, but like, what is the concern? What kind of noise do you think that these computers are making? Buzzing. They're going to be put literally in commercial areas where there's like a gravel place. Well, I mean, it's pretty decently far away from my house, but like, how much noise do you think these places make? Or an airport? I don't know, man. Water guzzlers. Yeah. L take. Dude, I just it's like this guy's saying lights. Like, it's got lights. Yeah, it's a building. How's that different than an Amazon warehouse or something like this? Like, I don't know. We're acting like this is the first data center that's ever appeared, like as if AWS and Microsoft Azure and Google Cloud weren't building a ton of data centers before this. Maybe I'm delusional. I don't know. Okay. What do you think about Amazon in this market? I mean, it's hard to bet against Amazon. I think the diversification of their business and the areas that they're tackling. I've got a Costco membership, you know. I constantly am ordering off of Amazon. Or because some days I just don't want to go out. I just don't see how it doesn't just continuously increase as a percentage of overall spend, especially as, you know, newer and newer generations just find more and more of their products that they want online. And then there's a larger share of overall products that you're looking for that are on Amazon, easier to search for, cheaper, and the cost is extremely low. $10 a month. It drained all the water where the data centers are. All right. But let's say about the new data centers, like what Nebius is putting in, where they're closed loop water systems. This is the part that I don't understand. Like, do we not believe the assumptions? Like, do we think that Nebius is lying whenever they say, hey, we're using about the same amount of water as about 2 Whataburgers, and that we're not looking to continuously take new water? Why are we not making a stink about every single industry that's taking a bunch of water, for leisure, let alone for maybe one of the biggest productive or productivity revolutions in history? No, we don't believe them. All right. You can bring a data center to water, but you can't make it drink. The people are wiser now. Yeah. You're just biased. No one wants a big ass ugly data center near where they live. Yeah, but I don't know how it is in America. In Canada, we have residential zones and then we have commercial zones. I'm almost 100% certain that that's exactly how most of your city planning is done as well. And that those commercial zones are filled with gigantic, absolutely gigantic, Boeing-like, factories, huge buildings put in the middle of nowhere. Like whenever people say, oh, there's a data center coming in New York, I think people imagine that they're replacing Central Park with a data center. When the truth is it's going in, northern, the northern part of the state of New York, which nobody is there. No, it's not how it is here. I mean, you're just straight lying. Okay. People still live in upstate New York. Okay. We can have you're on an investing show. This is like an area for which a lot of businesses are constantly putting in new factories. And you can point to a factory that produces cheese, a factory that produces cars. And, these bring in a lot of jobs and people are very happy for those to be built in their areas because, some towns are built up because a single auto plant was put in that city. That's the way it used to be. Like an entire, a huge percentages of small towns would go work at that auto manufacturer. But then why are data centers treated differently as if they're completely like they don't produce jobs and no one works there and they're like a lights off robotic factory? Tanner, you need to show some empathy. Empathy to who? To who? What I feel like I'm going crazy. Like this is like, oh, well, this is Native American land. Like you're putting data centers on, what? It's to our, I'm in a town, I'm in Toronto, I'm in the same city as you guys, Why would it be any different? They're trying to put data centers here as well. I live on the same earth as you guys. You're like, I think they're trolling. I think there are trolls amongst you. I completely agree. And my stress level is not even remotely rising. I'm having a good time. But I am curious that, like, do we see no economic benefit? Are these purely negative entities? I just don't see technological advancement like that. You know, I think for generations and generations, as we've tried to produce technology to farm better or kill pesticides or sorry, kill infected plants and all the, like, as we've been able to do a lot of these advancements that have helped feed more people, build houses quicker, human lifespan has increased, which has led to more challenges, more cancer, more stuff like this. Like, I get that, but I'd rather have, you know, increased cancer and live to 85 than die from some disease at 35 because we didn't have a cure. Like, am I going crazy? Anyway, a much needed switch of topic as we introduce our next guest. Ladies and gentlemen, please welcome Chad from Palantir.
Hey.
How you doing, man?
Good. It's a little crazy times right now.
Oh, yeah. Just caught you right after earnings, and I'm sure it's quite busy there. I won't keep you for too long, but obviously, Chad, I appreciate you doing this. I'm a new Palantir investor. I'm trying to understand this business, and I think, like some, it can be considered a little bit of a black box. I know that you guys have been way more transparent in helping retail investors understand this business, but hopefully I can pose to you some questions and you can help me understand the company and why you guys are doing just so unbelievably well.
Yeah, that's awesome. This is my favorite thing to do, is to educate about what the heck we do, because it's not simple, and people want to, you know, kind of boil it down to something easy to understand, but in reality, like, it's complex. It just is.
So what is the magic sauce of Palantir? Everyone talks about ontology, but can you first explain that? And then I've got a couple questions about this sort of idea of an ontology.
Yeah. So I think there's a couple and on my X profile, you can go look at the pin video is kind of a deeper dive explanation of the ontology.
Sure.
You can find that. But the goal out of the ontology is to model my business process, how it actually operates, not how systems do. And so traditionally in the kind of the business world is you model data for how things are in systems. And so everyone's used to the reports and their fields that they're trying to put together. And it's like, I've got these fragmented things all over the place. So then I build Excel spreadsheets, and the goal around the ontology is actually to model that entire connected business operations at the finest grain of how it actually operates. So, like, when I say it's complex, it's how do we embrace that complexity, and how do we scale and model it with the ground truth of how things operate versus in a system language that people have to translate for. So that's one. And then we're also modeling not just the data, but the logic and the actions of your business, because a business process is not just data. That's really just the current state. You have to have the logic about how to think about it. So whether it's an optimization or it's just a simple rules-based thing about where does product go when and where, or the actions, the levers I can take to adjust things across my business. It's all of these things that actually have to be modeled together for a business process, which happens to be the perfect thing for agents and humans to work on. And so that's really the secret sauce, and why it is because of all those things come together. And then we get into the whole fun story about, chips and ontology and how we leverage the different LLMs and forward deployed engineers. So there's a lot more to it, but the ontology is really at the center of it for both AI and humans working across Palantir.
So I understand as I was trying to do some research on this idea of an ontology, or this digital twin, if you could say, why is this hard to replicate, and what makes Palantir be able to solve this problem that potentially other businesses cannot?
So everyone's starting to have an ontology. People are talking about ontology. We're seeing all sorts of people come up with their own version. Most of these are just a graph database. They're usually just based on Neo4j, which is an open source graph database of sorts. and it's short-sighted in the sense that they think it's just about modeling the data, and they're trying to sell consumption of a platform. And so the difference here is like we're building stuff that's a lot different, where we want to have this kind of this context graph or this knowledge graph of how your business operations, and it needs to be real time. It needs to be operational versus I'm building a report. And I think the best analogy I can say here is like most of these other systems, ontology or not, are like if I'm trying to win the game by watching the scoreboard, and Palantir is the playbook helping you make the call on real-time data right now. And so when people try to replicate these, they're replicating a name alone, and really don't actually understand the differentiated value in what we're doing. And this has become because we worked backwards through our forward deployed engineering through the hardest problems in the world, whether it's on the battlefield. And if you're on the battlefield and you need to understand like what's going on, the data, the logic about how to think about like where are people, what's going on, what are my options, what's the optimal thing to do, and what are the actions I can take to keep myself safe or attack the enemy or whatever it is. Now that same thing can be applied to the business context. And so it was built in that space in an operational nature for driving those decisions. And that's what we talk about Palantir is like a decision-centric system, because that's ultimately what a business is a bunch of people making decisions. And so that's really what we focus on.
And so can you give me just a little bit of you don't have to go in too much detail, but what is your general day-to-day? Like how does that start?
Oh man, let's see. I start with roasting Amit on his channel.
Yeah,
that's usually a favorite while I'm drinking my coffee. Yeah, so it varies a lot. So like when we talk about forward deployed, like that means I'm all over the world. So sometimes I'm here at home. It's great, but a lot of times I'm out talking to customers. So I spent the last week and a half on the road in a different city talking to different C-suites about sovereignty, for example. So I do a lot of different things. So my general day-to-day can be from educating executives about Palantir to talking to use cases to how do people organize their business to utilize Palantir in the best way, all the way to I'm talking to our product teams. We're building new products. I'm giving feedback. And then it's the social media fun is in between all of those things. That's the side gig of helping explain Palantir. But generally I want to go get the signal from the customer. And so that means I got to go sit down next to the customer and truly feel it, not sit over Zoom. Like it's hard to do it over camera to get that intuition, the feeling, show me what you're doing. Even at the executive level, you've got to go actually sit down next to people and get read the room, feel how it like the culture, the people, see things. It's a lot of times most important conversations happen after the meeting in the hallway, right? Yeah. And so you miss out on those serendipitous moments if you're just in your office at home. And so that's I'm all over the place. I basically do a lot of special projects and partnerships, the NVIDIA stuff, all of those kind of partnerships with Databricks, Snowflake. I'm helping, kind of work on all those things. So all the fun things that people love to talk about, the intersection of Palantir and, Ondas drones and NVIDIA and all the others that people love.
Yeah, I didn't end up getting a Palantir hat for the interview. So I'm wearing NVIDIA as being a partner in solidarity.
They're great partners to be with, by the way. Like they are truly in the boat with us.
Yeah. Wow. I wanted to also ask a little bit about, you said you were on Amit's show earlier. Retail really picked up on this stock early, like from DPO. Why is it that retail understood that there's a real differentiation in Palantir's story, but your day-to-day is going through and explaining to executives why they even need your product in the first place? Like what is that disconnect?
I would say the software industrial complex has taught executives how to buy software that is beneficial for software vendors, not for them, for the last 30 years. And they're selling a widget. And as an IT executive, and this was me. I mean, I was an IT executive for 15 years at Fortune 50, right? And so I've got to stitch together all these tools. I'm going to go on a shopping spree of this tool, that tool, this tool, and I'm going to put together to create my architecture. And here's my system. And I'm like, wait a second, I'm not a tech company. And so what am I doing here? And I end up with these fragmented systems that kind of half work. I'm buying software from all the different pieces that are easy to buy. It's this piece on my architecture. Well, that's the best in class. And this one is the best in class. And this one's, Well, they have different security scaling mechanisms. Some don't work how they advertise when you try to scale them, right? And so all of those problems are why people are like used to this. I'm just buying my widgets. And Palantir is this convoluted thing. It's like inside of Palantir, there's 90 plus different kind of tool sets that all work together. It's very hard to sell. They're like, well, I already have this thing. I already have that thing. Well, maybe it's not the best in class in this one thing over here. I already built out my architecture. I don't need the whole thing that replaces everything. So that's one. I think two, the other side of this is everyone is focused on a KPI and a metric, right? I run my business because I want to report. Well, like the evolution of this, a lot of times when people go to the cloud is I've got my data in one place now. And they thought that was the end goal. I built a cloud data warehouse. Before that, it was data warehouses. It was on-prem data warehouses and database. And I built the DB2 query engine at IBM back in the late 90s, early 2000s. I've been around doing this a while. Like, it's just been the scaling of databases to try to get all the data in one place. And the problem is the data in one place is just the first step. You actually have to do something with it, action it. And that's where the forcing function of working with the U.S. government and our warfighters is, well, I actually have to do something with it because my life is on the line. And that is the forcing function of how we built the platform. And then when we saw the commercial side of this, it's like so many systems are about finding insights. There's the memes even about this, online. It comes back to I actually have to make a decision, not just actionable insights. I have to make that actionable insight real. And did it have the intended outcome I wanted, which is really where you create that continuous learning loop or the OODA loop. And so there's a lot of different reasons why it's been convoluted. I think, the retail community maybe not being actually as in depth about the world of how to buy software and all these other things. So like, man, these guys are doing something different. And I was an early Palantir commercial customer. So before I came to Palantir,
Gotcha.
I remember I first met Sham, I was like, who is this? And like, why are they making up words like ontology? Like, so I had, I was the IT executive having that same reaction. I'm like, I already have AWS and Azure and Google. Why do I need these people I've never heard of? What are they going to do? Anything better than these three biggest companies in the world, right? Why would they? And then when I got my hands on it, I'm like, holy crap, do you guys know what you have here?
Yeah.
And that is where like we're seeing now the inflection point where it's like, holy cow, like where have you guys been? And so I think we're hitting that critical mass where people are starting to see it.
So I was following this company probably since DPO, not taking it probably as seriously as I should have, because this was the moment where, growth had sort of decelerated down to about 12% year over year, and then obviously took off since then. What was that spark that, is this new products, new sales teams that enabled you guys to really turn up the gas and go up to what I think was 93% year over year growth? And how has that changed your day to day in terms of the hours that you're working?
Yeah, it's been exhausting. It's like I joke that I don't think Dr. Karp knows what day of the week it is, because like Sunday night, Saturday morning, you never know when you're going to be working. But we have a lot of flexibility, so it's actually when you're having fun, it doesn't really feel like work. But the growth side of this has really accelerated, when we launched AIP, our artificial intelligence platform, which really just integrates different LLM capabilities across the platform. But it was really about how do you orchestrate intelligence? How do you fight against the hallucinations and others of these models? And so like the ontology is the grounding layer of your actual business operations, which the models hopefully were not trained on, your internal business data. And so it acts as the bridge to be able to reason across your business operations and how you're actually operating. And so the two of those together was kind of the ignition point. And then everything we've been doing has been reducing the friction to get to that faster. And then it's like, oh, I built an agent. Okay, cool. I get it to production. Now I need 10 agents, 100 agents, thousands of agents. How do I manage that? Who's owning this intelligence? So it's every step of the way, it has caused new problems. and then we have uncovered new things that we got to go build. And so the way that we're compounding so fast, I think the speed that we move, we're really seeing that compounding effect now because we're learning so much faster than everybody else. That's why we're building the products that no one else has, is because there's no bureaucracy. There's nothing else inside the company that stops us, and we move so fast. We're finding out the things that people don't even know they don't know yet. And those kind of feeling truths that we're finding around, like, how do you scale massive amount of models? Like, should we be owning our own intelligence? Are we giving things away? Like, how do we own our own intelligence? What tools do we need? So those are all the kind of things that we start to uncover that has really exploded the growth with, I think, negative headcount. So, we run Palantir on Palantir the way we want our customers to run. So from an efficiency standpoint, we have grown like that with less people. Like, that should tell you something compared to other competitors. Like, we're going to sell you a sales tool and we need to hire more salespeople to sell you the sales tool. Like, no.
So I talk about this a lot with exceptional companies, but it's culture. And I've always gone back to Palantir, just wondering, how have you guys created such a culture of going on during your time where you still have to talk to customers and saying, hey, I'm going to explain this to this retail investor or these retail investors so they understand this business better. What is going on at the culture of Palantir? Are you guys happy to work every day? Does it get tiring?
It's tiring. I joke that I'm kind of a forward deployed therapist sometimes for our young. I mean, everyone here is like, I have kids older than half of these FDEs. I literally show up at a customer and there's, I've got an 18 or a 19-year-old meritocracy fellow, who fist bumps the CTO of a company. It's like, oh gosh. But this kid is the most brilliant engineer, and so the culture is very meritocracy. There's purposely no structure. I mean, I can't, like, people say that, but there literally is no structure. I was a few minutes late to yours because I was talking to a forward deployed engineer in London who was going through where everything's going on all crazy. Like, what do I do? How do I do this? How do I manage the people? What are we doing? Like, that is happening. And the cool thing is, like, every week I find out of an entire, like, new massive initiative of some really cool thing that I had zero idea was existed, and someone's been working on it for the last 3 months. And so the cultural piece is you have the autonomy just to go do. There isn't a command and control. There isn't a let me go ask. Like, I had to deprogram myself. Like, hey, can I go do this? Or, like, why are you asking me this?
Yeah.
Like, can I get funding for this? Yeah, just go do it. Right? Like, that is the culture. And so like, we're able to execute, like, the sovereignty thing we can talk about in a minute, but, like, we did a sovereignty boot camp. We literally, like, just decided to do it 10 days from now, or 10 days from when we planned it, launched it, and we had 101 different C-suite customers in our office in New York talking about sovereignty. Most companies would have taken months to go plan that. We wrote a white paper in a day and a half on sovereignty. Like, the 9 bullet points that made it out around sovereignty. I think I got a phone call from Dr. Karp at, like, noon, and we posted them by 4 the same day.
Yeah.
That is the kind of things, like, how many cycles did we get in there before someone else would have just had meetings about it?
Right. 100%. That makes a lot of sense. So running so fast, not asking for permission, and, if there needs to be changes, then the company can discuss it, and if you're hiring all A+ players, then they don't necessarily need to be monitored.
The distinct thing about Palantir is it's very spiky. You just need to be the world's best at a thing. You might be terrible. Like, I am. It's funny enough that I'm, right on our social media. I am the world's worst speller and, like, at English. So I have a workflow that helps me, like, proofread and do things before I go post things. I'm the last person you should have doing that in reality. I happen to be good at explaining how the product works, right? And, and those kind of things. But we have engineers that maybe they're terrible at this. And really the thesis around the culture is stop trying to be better at the things you're not naturally good at. And actually the superpower is to actually lean into the things you're just naturally have ability for. That's how you become 10 times better. And that's really the focus across the company, is a bunch of people that might be weird or different or at different things, but as long as you're like the best at one thing, the rest of those things no one cares about. No one's going to force me to go take a class on English or do some speaking thing or whatever. It really comes back to, hey, just use your natural abilities.
Right. Karp in his recent CNBC interview talked about, if you're helping generate $1 billion of revenue or saving a company $1 billion, you should likely charge about $300 million. That sort of 30% take comment that he made. And tell me if you can speak on this, but the customers that you had probably grew by 25% within that range. I could be off. But revenue grew by 93%. Net dollar retention grew by 57%. How does billing even work at Palantir, and why are customers coming back to pay you guys more? What do they get out on the other side of that? How do you bill a customer?
Yeah, so every single contract is negotiated.
Okay.
There is no easy mechanism. There's no price sheet. There is not a rate card for forward deployed engineers.
Yeah.
Everybody is like, you guys are crazy. But we are signing up for the outcome, which means I have to assume risk. So people like me that have been around the block are coming in and like looking at these scenarios and figuring out, hey, we're going to assume risk and just move fast so that we don't spend 6 months talking about this thing. We'll have so much done in 6 months if we just assume some of this risk. And if we're aligning the incentives that we're getting a portion of it, or however we structure the deal, because every deal is negotiated and structured however is beneficial for the customer, can be a lot of headache and upfront of like, how do you guys charge? This is weird. You just look at how deep my pockets are. You hear all those things, but it comes back to, why are people coming back and why is the net dollar retention expanding as it is because if I'm investing $10 and I get $20 back, I'm going to do that every fucking day of the week. And even better, if I'm able to spend $300 million and get $1 billion and I get $700 million, why would you not be coming back and doing more of that? And that is the proof in the pudding. There is like, in the actual numbers, those don't lie, that people are coming back because when they make a partnership with us, that investment is getting them the return, and they want to do more, and they want to do more. Versus, I buy a product, no one's helping me implement it. I have to have my people do it, or a consultant or someone else, and then I'm paying for consumption. And so there's no kind of tied incentives because actually a lot of these software companies are incentivized by you consuming more. They don't care about the outcome, because as you consume more trying to get to an outcome, they get paid. And so that's where we have misaligned incentives, and that's where Palantir really comes in. And that's why it's so important when it's like, we operate on first principles across a lot of different things. That being one of them is like, we will not go to market a different way.
Now, another thing that Palantir and, for new people like myself, as I look into this company, cash is just continuing to stockpile. I think we're at like $9.4 billion total. Growth is at 93%, but if customers, is it that there's still a long list of customers that still don't know that you guys exist, or that the offer is so much different than their competitors? Or why can't you accelerate that even faster if the whole world needs to switch over to use Palantir?
So I see this as like, we want to find customers that are the N of one as well, like, and that want to be differentiated, that want to partner and like do something real and big, versus, could I go make money doing thinly, developed products on the side that are not necessarily durable or long-term? So this comes back to, we're building a thick, durable product that has long-term revenue, not this short-sighted, I got it for a year and then I'm just going to keep cycling them. And then you get into this parasitic relationship where software vendors, charge more and the product gets worse. You'll hear Dr. Karp say that all the time. And it comes back to, if I just focus on customer count and expansion versus building deep relationships, because the product expands and gets built through those deep relationships, which makes them better, which makes us better. And so we only want to work with people that are going to have the level of ambition and excitement to go do this for real at scale. And so that's like where our focus is. Now, as we're seeing this, more and more customers are kind of realizing like, hey, I didn't go with Palantir. I tried this other one that's not working. So I think at our last AIPCon, you heard Dr. Karp say, oh, go to the labs, go somewhere else. It's our best sales tool. And it's true. Like, I show up at customers and they're like, oh my gosh, this didn't work. If you look in our earnings letter, or actually the transcript, Sham had a good use case about us going up against one of the labs at a customer. and kind of what that experience was. And it was exactly this of like, actually, even the lab with the same model we were using without Palantir and our real forward deployed engineers, the outcome was distinctly different. And that's where customers kind of have to feel that pain naturally. And I think they're really starting to feel it now. And that's why we see a lot of this growth. And we don't really concern ourselves with the customer count. Like, it's more about truly partnering in a way that like there is going to be value creation.
Yeah. I think that's fair.
And by the way, you should go, I sent to Mitt this, but you should go look. If you go look at the customer count for AWS, there's like 4 million customers. 0.1% or 0.01%, like small percentage of customers, it's like 4,000 out of the 4 million, spend over $1.2 million a year. If you look at our average customer spend, much different story. So when you look at the actual like revenue and customer from comparison of like these massive customer counts versus this, I don't think people realize in enterprise software, a lot of the customer count is just small, tiny, $50,000, $100,000 a year type stuff. And like, is that where we should be focusing on for revenue growth if we're trying to drive value? No.
I'm going to get the quote wrong, and maybe I can get it up in time. I'm not sure, but you guys made a comment about something like 25 basis points of the Pentagon's budget is going towards Palantir or something along these lines. And that even though this could be a single customer or something, you guys are at a very, very small percentage of their overall spend. So worry less about the size of the customer rather than the quality of the customer, I guess, is what the takeaway is.
And it comes back to the first principles. This is why I call like the software industrial complex. It really is sick. Like it is a parasitic relationship that has been there for the last 30 plus years, which is why everyone is gravitating towards and like excited about the sovereignty stuff, because it's not just about models. It is about sovereignty at the data layer, at the application layer, at the model layer, that everyone has been stuck with an ERP vendor that has put a gun to their head about, hey, you got to go move to my new platform and it's going to cost you $250 million. Like, wait, but I built my whole business on this thing. Like, you don't have sovereignty at those points. And so it's a bigger deal when we talk about this, is really around like value creation is at the core of everything, which means I have to partner deeply with people.
Well, let's talk to the sovereignty. Karp really popularized this, but this idea that, some of the relationships with the labs can be very parasitic almost, that they are using your data to help train their models. And that's at the expense of that company's data secrets that will now be shared with everyone because they don't care about the short-term relationship that they're having with you. They want, smarter and smarter models over time. Is that the right way to think about that?
So I've been touring, I won't say that I can like cleanly define like exactly what I think sovereignty is, but this is kind of my working theory. And I'll break it down into like 4 different groups of customers when the sovereignty when I talk to about this. Like my version of sovereignty is like, I own the decision rights to be able to operate my business no matter what an outside vendor, software company, or someone else does. And you can put this in the terms of manufacturing. I build a manufacturing plant. Can I get parts to fix this machine? If the machine breaks, am I screwed? Can I swap out machines? If I lease a building, do I have a lease, or is someone going to rug pull me and now I have no building to operate in? Can I afford the downtime to move to another facility? Like, those are all rights in the physical world. You think about those in the software world, it's okay, cool. I can change, people think that changing a model is just to drop down from this one to this one. It is in reality, in production, it does not work like that. They do not work similarly enough that if you have agents running at any sort of scale, you have to have proper evals. You have to understand what prompt changes might need to change, architectural changes, tool changes. Their permutations are massive and they're changing all the time. Or you have in the case of like Anthropic, who might change the guardrails on you midstream. Now you lost your decision rights.
Yeah.
So that, in my mind, is like at the core of it. Now, there's a lot of different ways that intelligence and other things leak through this. So they're like the 4 different distinct customers I see. Like, one is the last 30 years, the software industrial complex has found a way to get me to buy their software, build my business on it, and then change the rules of the game and charge me more while the product gets worse. That has been the parasitic kind of relationship. So people are like, oh, I'm going to go build on this lab. and now they're going to do the same thing. Okay, that's kind of group one. Group two, it really comes back to why would I want to fund someone that's going to come compete with me, like they did with the Claude Design or others, drug discovery, science, right? These things. So these companies like Walmart won't use AWS because they don't want to subsidize like someone that's going to turn around and compete with them. So that's a pretty valid concern. So that's the other group, is you have companies that are doing drug research and wait, why would I want to use one of these labs models and pay them to then fund their growth to then come back and take my business, right? So that's kind of group two. Then there's the third group is really around, I can't afford someone to change what the model can and can't do or what I can ask the model. That, you heard in the Department of War with Anthropic and others, oh my gosh, they can change the rules where it's still the same model endpoint, but also different guardrails and things are happening in the background that I lose decision rights, right? So I need to have sovereignty over and control over that model. And then the fourth group is around price. I'm putting a PhD on the factory floor to put things in a box when I'm putting a frontier lab on most enterprise use cases. Most enterprise use cases don't need PhD level intelligence. They need a thing that's going to go reason across ontology or whatever in your business process, go figure out what to go do, recommend something, and take an action.
Yeah.
It's not PhD. So what do I need to do is I need to train the person to do this task-specific thing, and I need to have intelligence orchestrate a lot of people doing that, right? So that's where we come into like fine-tuning open weight models, where can I create task-specific models that actually fine-tune to a task? And the other side of that is not only is it open weight, but I have the right level of weights. It could just be a non-fine-tuned open weight model, maybe a smaller, cheaper, but I don't have to have the massive set of weights that are expensive because I'm running inference against this massive set of weights every time for the simple tasks. And so when we talk about, you might have heard Sham say this as well, is like, we're not even using the intelligence we created. Like there's all this intelligence out here that's being unused on a harness today. And so that's really where we focus on. And that was where his comments were around, we used non-fine-tuned Nematron Ultra did better than Frontier Labs on a lot of the use cases we tested on, even though the benchmark said something else, right? So anyway, that's the breakdown of the sovereignty piece.
Do you think that a company like OpenAI, for example, that launches like the Sol, Terra, Luna, can also be the orchestrator of, thousands of agents that, pick whether or not they need PhD level at Sol or something lower for their Luna models, and that they still could compete, but on a different set of their own models?
Yeah, I don't think there's going to be one answer. Like most of the time, what I see customers is they want to use some frontier, they want to use multiple different models, they want to test them out. So we have a product Evolve that helps you actually figure out what's the right models to use. Sure. Sometimes they're frontier, sometimes they're open weight. It's your choice. And so this comes back to, I have sovereignty at the data, storage, compute, models, and like business layer. At that model layer, I might want to interchange these different models, or at least have the ability. Because like I think about sovereignty, and I have to have the choice and the ability to make it real. Because it's one thing just say, oh, I can switch models. But if my business is running on, I don't have the ability to like practically do that, then I don't really have sovereignty. And so like the Frontier Lab models might have this intelligence router that they can go do some of this. The question is, as you start to encode your business process into things, what are they doing? So some customers, and I think most customers actually probably will still use models from the labs, like 70% maybe, are just going to use the lab models. They don't want to use open source ones. They don't want to fine tune. That's great. Fine. We have zero data retention inside of Palantir with these labs and others. So like we have protections, but sovereignty is a spectrum. Some use cases I'm okay with just contractual ZDR. Other use cases I have to have a control over when the model's updated, what safeguards are in place, and I want it to run on my GPUs because it's drug discovery. It's whatever those different things are. And so that spectrum, we have to give our customers the choice and the ability to move up and down that spectrum.
Now, in terms of the commentary on commoditization, what is, well, obviously I've heard Carp talk about it, but what's your sort of position in terms of how can these frontier models stay frontier if, Chinese companies are constantly distilling them? Does Palantir even care? How does that sort of work out for the business?
I don't care. We've been saying this for 2 or 3 years now that LLMs are a commodity. Intelligence is escalating at a J curve, and cost is going down. That is literally a freaking commodity. And now the open source models have even proved that even further. And so it really comes back to all the values can be accreted to the application of these things into the real world. Just like oil is a commodity, I have to get a truck to go deliver product from A to B to be able to go add value. Like I have to orchestrate something. Oil and fuel is just a piece of that that's going to help it happen.
I wanted to go back to this sort of question that I had when you were talking earlier. And this is not, I'm not saying this to be accusatory. I'm just curious if you guys ever think about this. This sort of software and industrial complex that you talked about, where these companies work to gain market share and then the product ceases to get any better, yet they charge more and more as switching costs get higher. How does Palantir, what is Karp's answer to saying, hey, that's maybe what Palantir is going to do as they gain market share? What's the sort of moral commentary to saying that you guys are not going to be, parasitic in your pricing in that sort of way?
Yeah, I mean, I think it comes back to, the only way we get paid is on outcomes. If we're not getting if we're not getting paid, if we're not driving the outcomes that have that 5 times, 10 times ROI, then we don't get paid.
So the actual way that you guys price and bill your customers is just completely different to insulate across that problem.
It comes back to the Charlie Munger quote that I overuse, but it's the show me incentives, I'll show you the outcomes. Mm-hmm. It really comes back to that core parasitic piece of, I had a software vendor when I was an IT executive that was going to miss their quarterly revenue. What did they do? They showed up on my doorstep to do an audit. This is back in there selling by seats and other things. And they're like, hey, you had production data in a dev instance. And I was like, yeah, I had to test something out. And they're like, well, that's a $2 million fine. $2 million out of my budget because they were going to miss their quarter. It was like clockwork. When I could tell when this company was going to have bad quarterly earnings because they would start to come and audit me a month before the end of quarter. That type of parasitic stuff still happens all over the place because people are incentivized by consumption of their products. And that's just the wrong way. Because what happens through this is the customer assumes all the risk. And we think we should assume that risk with you.
Yeah. Yeah. Now, how do you audit that? How do you, I see a lot of customers say, we saved $300 million or something like this. But whenever it comes to billing, I would be incentivized from my angle to say, yeah, I saved $1 million. So how does that work?
It really isn't an issue because customers, we know, if someone's lying or trying to play those games, if they want us to come back to make them more money, then you better not be playing the fucking games. And most of the time when we have good partners, when we're making that kind of money for people and they see it, it's a good relationship. They want more of it. And so this comes back to it's kind of like a false bullshit thing that everyone will throw up as FUD is oh, we can't do this because someone might try to rip us off. Well, if you're actually acting on the best of your customers' behalf, people love you. And they want to do more. And if they want to do more, they know they have to be fair and honest like we are. And that's when we first launched AIP and Dr. Karp said we have no pricing strategy. We literally had no pricing strategy. Even today, what are we going to price? Well, it depends on what value we're going to add.
Yeah. Which constantly is improving as, you said a new engineer is creating something that goes across many different customers' needs.
That means I need to create more leverage in my product to be able to deliver more value quicker. So the incentive is to make the product better so that it delivers value with less engineers for the customer. That's why our, kind of dollar or revenue per engineer is off the charts. Why our headcount's going down, right? It's all of these are those natural things by operating from a first principle. Now we didn't get here overnight, right? It's as everyone knew, it's been painful.
Yeah.
But operating from first principles and then now getting to the scale mechanism has really been the kind of the proof point for everyone.
Chad, what didn't we cover that you think is important that, as myself being a new investor or some people that are potentially looking into this company, not just from an investor perspective, but I think an important part about being an investor is understanding what you're holding.
Yeah.
What is retail investors' most misunderstanding about the company?
I think right now I hear a lot of the misconceptions about what forward deployed engineering is, and like, oh, Microsoft just launched 6,500. Everybody now has forward deployed engineers and like sparkling sales engineers or whatever. The biggest misconception here is like, oh, well, someone else is going to have forward deployed engineers. That's what they're missing. You need AI and forward deployed engineers because customers don't know how to do it. So you need smart engineers to go do it for them. Like well, for one, that's discounting your customers' intelligence. Oh, like our customers are brilliant at their thing.
Yeah.
They're the world's best at their thing. They got to the scale for a reason. Their intelligence is in a different area. And like, so you have to have some hubris about like actually, the guy on the factory floor is like the expert in his thing. You should probably listen to him and not think you know better. And the nurse out on the front line, like these people, like they're the people we're fighting for. And so when we talk about like forward deployed engineering, it means I am like going and standing next to the person there, understanding what they're doing. Why is this painful? I thought you could just do this. And they're like, no, you can't do this because of these things, in the real world. You're like, oh man, well, I would have totally built a different product, or I need to build this thing so that it makes your life easier. And then I'm going to build it and go out there and see how it works or it doesn't. And I'm going to give you feedback. So that like forward deployed engineering is actually the product strategy, not the go-to-market strategy. And that is the biggest misconception everybody has. And it's like, oh, well, these labs have the deploy codes. They're going to go eat Palantir's lunch because they have forward deployed engineers now.
Yeah.
And I call bullshit. Like it's just, a bunch of fluff. I don't see that in reality. I think there's very few people that actually understand the nuances about how to actually make the forward deployed engineering work as a product strategy.
Chad Walquist, thank you so much for joining me, man. Really do appreciate it, honestly. That cleared up a lot of the questions that I had. I put your X in chat. I don't know if there's anywhere else where people can reach you or...
Please don't reach me on LinkedIn. I fucking hate LinkedIn. Yes, if anyone wants to ask questions, like please hit me up on X, post questions in public. I'll answer them in public. So very much love engaging with everybody, but thanks for having me, man.
Thanks for joining me. Talk to you soon.
See ya.
How amazing was that? Yeah, shout out Chad. Chad's a real Chad, man. Absolutely love that. You know what? There's no better way to get answers about a company than just speaking with the actual people that are deploying the product. You can talk to other investors, other Wall Street analysts, and try to get the regurgitated commentary of what they believe is happening at Palantir, but we just heard it right from the man. So thanks to Chad again. Give him a follow on X. He posts a lot about Palantir if you want to get to know that company a little bit better. Going back to the markets, did we miss anything from the stock market while we were talking with Chad? S&P 500 down 0.16%, not to draw any fear to anyone. Chillax, it's a regular day. NASDAQ down 0.1%. Chime starting to lose a little bit of its gains here, still up 24%. Clover Health up 12.7%. Unity up 16%. Did they show off earnings this morning? That must have been what happened. Because, wow, that's a big gain here. Unity was this morning. Looks to be a large double beat. Revenue beat by 6.3%. EPS beat by 27.3%. Good sign there from the stock. SoundHound ended up showing off earnings last night. That's up 9.2%. Abcelera also showed off earnings last night, up 8.9%. You can see some of the reactions from last night's earnings completely sold off a lot of these stocks, right? Elf Beauty was another one. Look at the reactions during earnings to then only be up over 8% today. Where is AppLovin? This was one that ended up selling off and, wow, still flat, down 18. Well, not flat, but flat across where it came back on the earnings call, down 18.6%. Shift4 Payments down 19%. I'm going to call it quits on this name. It's been a good run, but you know what? This is why one of the principles, and anytime you break a principle in your investing strategy, usually comes back to bite you. But you need to invest in founder-run businesses, and that's what Shift 4 was until it wasn't. And Jared Isaacman left, and you can see it almost in the chart. You can see where he left because we went from an all-time high, immediate red candles, and Jared Isaacman went to go, work at NASA. So not that he's not doing great things for the American people, but whenever it comes to my specific portfolio in this name, that's no bueno. Don't like that. Datadog down 17.2%. What a bloodbath that is. Holy, I didn't get to see their numbers yet. Datadog ended up showing off their earnings this morning, and it's a huge double beat. Okay, what happened there? Revenue beat by 4%, EPS beat by 33%. Why is Datadog down? Let's use some artificial intelligence to find out. Okay. Hertz is up 33%. Oh my gosh. Their forecast was bad. Is that right? Q3 guidance, roughly in line with or only modestly above some consensus figures, implying sequential growth slow down to 20% ranges. Yeah, full year guidance was actually raised, but below some of the higher street estimates. That seems like an overreaction. I mean, we must have a notable factor is reduced usage from Datadog's largest customer, a leading AI company. Management said that this customer recently signed a 9-figure renewal, but it's seeing lower usage starting in Q3. This impact was already baked into the guidance. However, this combined with the higher valuation with the sell the news dynamic is now leading to stronger sell-off in this pre-market, or now is mid-market. But okay, their largest customer is seeing a need to use their services less. Who knows? Maybe they're using Palantir. Tanner, would you buy Nebius dip? Yeah, I mean, the reaction to this stock is based on another investor saying that he doesn't like the company. Not new news coming out, nothing like this. The same person that's been betting against Palantir and NVIDIA, I think some of the strongest companies in the industry, is also betting against Nebius. I don't look at that as a bad story. What I do see is a company that I love that's at an incredible valuation, 195. It's actually so low that I'm likely to buy this over CoreWeave. But, yeah, we'll see. Okay. Tanner, do you know if D-Wave has reported yet? D-Wave, I mean, it says it did. I don't. Yeah, they're down. They reported this morning, it looks like, just based on the chart. I don't follow any of the quantum names, so I wouldn't know what happened. But I do know what happened with Chime, and we did that report earlier on. If you guys didn't see that, you can either scroll back, or I'll have a separate Chime update video coming out, either on the main channel or the second channel. If you guys don't know, we post, and same thing with what's going to happen with Chad's video. I don't know. It depends. That conversation with Chad was so insightful that I might even main channel it. But if you guys are not getting enough of me, even though I'm live for 5+ hours a day, make sure you check out the second channel. Let me post it here in the comments. And you guys can see it here. There's the thing. I'll just pin that comment really quick. And then we can also take a look at some Mag 7 names. Microsoft up 1.9%, leading the Mag 7 right now, almost looking to break back above $500 a share. If you guys are not following the second channel, it's at Future Investing. At Future Investing 2. We almost have 800 subscribers. Only recently launched it. I've got Amit's conversation that we did. Hamid's, Jesse's, Matt's, Jose's, mine and Chris's conversation about ServiceNow and NVIDIA and Micron and all of these names. So make sure you guys keep up to date with that one here. I'll show you guys the thing. Get this up to 1,000 subs, please. I beg of you. But, okay. Let's go ahead and go back and look at Google. Google is raising debt. They recently had potentially offered more of their shares. Berkshire Hathaway was a big contributor. They ended up raising $85 billion. Now there's rumors that they're planning on raising again. And in fact, we have Evan in the chat here. He posted about this. Look at the convergence of all of these communities coming together. Not only did Evan post about this, and here he is in chat, but he also posted a very awkward photo of me at the Google Cloud event. I mean, don't get me wrong. I mean, I look short as ever, and I don't know what I'm doing with my hands there. It's definitely not the photo that we agreed on, Evan. But that is me. Okay. But yeah, anyway, Google has started marketing a U.S. investment-grade bond offering. Google will reportedly sell the notes in as many as 10 parts with maturities ranging from 2 to 40 years. Initial price talk for the longest tenured tranche is a premium of about 1.55% above treasuries. I mean, not nearly as bad as what CoreWeave's putting up some of their loans for, but looking all of 5'6", I am not even remotely 5'6". I'm going to height mog some of you guys at the meetup. You know what's going to happen? There's going to be some dude who's 6'4" who comes to the meetup. They're going to take a photo with me. They're going to post it online and say, I'm 5'8", by the way, and I'm going to look short. And they're not going to be 5'8". Any photo that you see of someone larger than me, they're going to be 6'4". Tanner is my short king. I don't want this going around. I'm not. Any picture of me that includes some of my height disadvantaged friends would show you that I'm a tall boy. Okay, and don't get that wrong. All right, let's jump back in to the stocks. HubSpot down. Dude, I didn't realize Garmin's like a $60 billion company. Spencer said, did he just say he's 5'4"? Nope. No, I did not. I'm 5'11". Everybody knows this. Everybody knows this. And honestly, I look 6 foot. I mean, I'm just being courteous by saying I'm 5'11", but it's really, I've heard from a lot of, especially females, that I do give off the presence of 6, even 6'1". I've just heard this, some people say. All right, let's go hear from Cohere. They talk about Google's AI leadership shakeup. Let's have a listen to this.
Speaking of leadership changes, Google announcing a big shakeup yesterday. Chief scientist Jeff Dean is leaving after nearly 3 decades with the company to launch his own AI firm. And Demis Hassabis is stepping aside as CEO of DeepMind and moving into a chairman role in that unit. He's going to be chief scientist at Alphabet. Alphabet stock fell on that news yesterday. Let's bring in Aidan Gomez, co-founder and CEO of sovereign AI firm Cohere, which he started after leaving Google Brain. During his time at Google, Gomez co-authored a paper called Attention is All You Need that is widely credited with changing the AI industry and leading to the creation of large language models like chat. It's good to have you. Thanks for the time today.
Yeah, no, thank you for having me.
What's the general take in your community on some of these moves over at Alphabet?
it's a huge shock. So for folks who don't know Jeff Dean, and I don't think he's that widely known in popular culture.
He is now.
He's decidedly one of the most consequential computer scientists in all of history. And so what he's built at Cohere is what he's built at Google is foundational, and he's contributed to so much of the technology revolution over the past quarter century. To see him step outside of those walls is a huge, huge shock.
What do you think it does for Google's continued ambitions?
I think it's a setback for sure. I mean, he's an extraordinary talent. The others that he brought with him, like Sanjay and Oriel, again, just incredible names who've contributed so much to Google and DeepMind and the competitiveness of the organization. I would say Google's a big organization. That's part of the reason why I expect this group is leaving. But there are many, many capable individuals to fill those roles. So I don't think we can read too much into the leadership change. I don't think we can read too much into what's going to happen. A lot of times we see the different model players taking the lead and swapping. Google was written off for a long time. There was the code red when OpenAI was beating them at language model and had kind of run ahead. And then Google caught up and surpassed OpenAI, and then OpenAI got back out in front, and then Anthropic got out in front. So we see this changing of position in the market regularly. I wouldn't count Google out just yet.
Do you think these changes in their leadership rank help its standing in the AI race? And how long do you think it takes?
I don't know if it helps, because I think a lot of the reason for why talent would go to Google, would go to DeepMind, is to work with these people. Like, they are legends in the field. And so I certainly don't think it's helpful. The question is it harmful or not? I expect Google is incredibly well prepared for any of these sorts of changes and will be able to bounce back quite quickly. They have all the resources on the compute front that they need, the talent front, the data front. So I expect the impact to be modest. I wouldn't write it off, but it is certainly, I think it's a positive signal for everyone else. There's these big companies that we all track and that dominate headlines. But for the broader ecosystem, seeing these individuals with this talent and this pull leave to create something new and to innovate, I think is actually inspiring and will lead to more competition and more innovation in the industry.
I didn't know the Amish were getting involved with artificial intelligence, but still happy to hear from some of the smartest minds in AI right now. No, I'm kidding, but did see a lot of Dagestan comments and couldn't agree more. That dude's probably training right now. Okay. Let's see here. DeepSeek is also planning to significantly increase AI prices on some of their models. And I also heard from Chubby. If you guys don't know Chubby, this guy's name's Kim. He's an unbelievable source for a lot of artificial intelligence stories that are going around. And he just posted, "I'm going to cancel Claude. It's just so bad, I can't even believe it. It's just lazy." The most recent example, I have Claude check my inbox for important emails, summarize them, work with them, and send out replies if necessary. I caught Claude, again, simply not reading through the email threads to the end and just ignoring the latest emails. When I ask it, he said, when I asked him about it, Opus 5 just said, "Valid point, I didn't read it." I mean, seriously, what the heck? You have to babysit it every time. I think this is what happens whenever companies are extremely compute constrained, is that you start to cut corners because the amount of customers that are there to pick up your service is huge. And so you either take two routes, you plan ahead like what OpenAI did and you just get an unbelievable amount of compute, or you do what Kimmy did and you stop subscriptions because you don't want to neglect your existing customers. You want to make sure that they have the service that they are expecting from you. And if Claude's trying to do both, where they don't have the compute available, but they do want to sign up every single customer, I wonder if Opus 5 is just being a little lazy. I certainly hope not. They didn't even raise prices on it. It was, if I remember correctly, Opus 5 is the same price as Opus 4.8, a little bit smarter, but benchmarks and actual real world use is two different things. And Palantir obviously talked about it very recently, but I notice it too. There's a lot of times where OpenAI or something like this does not show up as or as well as other models. But honestly, whenever I'm using these tools, I've not had a better experience with artificial intelligence than what I've had with OpenAI, because it's just learning the organization much more. I say organizations, me and Marshall. It's like it just learns about this tiny, tiny team. And I apologize for exaggerating, but that's the word that it uses. It calls it an organization. But that memory, that context that it knows, the memorization, the going through and not having to tell it to make no mistakes and reread twice and all this stuff just makes it a better model, even if it doesn't, potentially benchmax and potentially shoot higher than Opus 5 or Fable 5. Tanner Inc. Yeah. You imagine if AI becomes more intelligent that starts procrastinating? It kind of sounds like it already is, but it's been told to procrastinate to keep compute costs low, margins high. All right. That said, what is the earnings tonight that you guys are looking forward to? I wonder if we have any. Who do we know that's Airbnb focused or Cloudflare? Roy, I know, is interested in Cloudflare. Let me see if Roy is available to speak on Cloudflare for a second. All right. Let's see if he's available. AAOI. I'm interested in AAOI's numbers. I don't want to listen to the call, however. Tanner, do you own Nebius? Very much so. I own a lot of Nebius. I actually trimmed my NVIDIA position back whenever Nebius was like $80 to buy more Nebius, because I thought it was like a screaming opportunity. And I don't think that we're going to get down to $80 prices. And if we are, I don't think it's the same valuation as where we were last time, because the revenue has grown so much. It's actually hard to put into words like how much growth Nebius has been putting up. They've almost every quarter have been growing as fast as, not the last quarter, but the quarter before that. You've almost been stacking the 6 month ago report on top of your new report every single time. That type of compounding is like 500-600% year over year growth, but that's what they've literally been able to hold up. It's wild. And then you switch back, right? No, I've not switched back. I was writing a ton of covered calls and still have some covered calls out on Nebius that hopefully can roll off, but I've rolled them out so far that either I got to pay to close them out, or I got to see actually where are those at. I'm pretty sure like per contract they wanted like $4,000. So I was like, I don't know. Maybe I just take the $4,000, just buy more Nebius. Okay. But yeah, this is my first real experience with kind of getting buried in covered calls on a stock. Got to tell you, it's not that good. But here, wait, how much do they want per contract? Yeah, like $4,300 per contract, and I don't have just one contract, so I don't know if I do want to buy them back. I'm not sure. I'm not sure how to really think about that. Okay. We will wait for a response from Roy, but likely maybe we're not going to be able to see that. And I don't know anyone that's a big expert on AOI that I think I'll be able to get on the show in the next 20 minutes, unfortunately. When's the expiration and strike? Dude, I feel embarrassed to even say. I think the expiration is something like March and the strike is $300. So it's been an extremely volatile name, but the reason why I've had to roll out so far is because we were skyrocketing. Yeah, I know. Invite Serenity. That's the exact name that I was thinking about in terms of people who do follow AOI. But clearly, I can't get. Clearly, I can't get Serenity on the show. I'm not underwater a $300 strike. I would like to buy them back and start writing covered calls again. And do I think that this company is going to be under 300 by March? No. It could definitely get higher than 300 by March. I know that sounds silly because like we're far off from there, but we have to remember the stock that we're following. Like this company's growing at like 600%. Okay. And so I'm not underwater right now. The part that I'm disappointed in is that I've held strikes that were going to July, that were going to August, that were below the strike price today. But holding on to a strike price to, early August at $200 whenever a month and a half ago is 300 just sounded like suicide. So I'm not, anyway, live and learn. Wait, I didn't want to sell covered calls that far out. I had to roll it was like my 7th roll. You guys don't remember. Go back in time. You're making me freak out. Look at this. I'll show you. So if we go here and Nebius, we go out a year, okay? You start writing like we were on this unbelievable tear. Okay, so the stock was range bound. And then I'm like here and I'm writing covered calls out to 130. So then we get a little bit past 130. So then I roll them out to, 160. We get past 160. And then we get past 180. So then I'm rolling to 200. And like it happened so many times. But then all that happened was that we just went up and up and up and up. Okay. We got to $300 a share. By that point, in order for me to still make premium, which by the way, no one talks about that. I made like probably $16 a share on my rolls. I had premium that covered the cost of the, my previous covered call. I made like $16. My average cost on Nebius is mad low. Okay. My adjusted cost basis is super low. But in order to continuously make premium, whenever the stock goes from 130 up to 300, you got to go out. Oh my God, he said March. Relax. The way that I was thinking about it is that Black Mamba, you've been here way too long to be talking to me with this tone, okay? Let's take a step back. Remember, there's no free speech in this chat, okay? I've got a ban hammer and you're on the short list. So, the way that I was thinking about it is that as I'm looking a month out or 6 weeks out, I was getting paid like to bring my price from 240 up to 300, just as an example, was giving me not only was it giving me premium, but I'm not guaranteeing, but like I'm locking in 240 to 300, like a 20+% gain to roll it out, let's say 6 weeks or 2 months or something like this. It's like, can I honestly sell at 240 and then find another stock that's going to find me that guaranteed return in a 6-week or 2-month period? I mean, the answer is no. I mean, maybe I could find another stock, but it's not like I could guarantee it as easily as rolling. So while I could get locked up at 300 or something like this, quarters out, I understand that. One, I don't have all my Nebius locked up. It's a percentage of my overall portfolio, probably like 40% or something like this. But then two, I forget where I was, where I was saying. Essentially, I'm fine. You guys are making it out to be a big deal. You can't predict the future. I think I did pretty well with the shares that I had and how I was rolling them. You can only deal with what the options market is telling you that you can sell at. I didn't want to get exercised early. It wasn't super flexible. La, 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 la. You're not going to tell me I did bad. Okay? I did fine. And I will have learned nothing and did the exact same thing again if it happens. Can we get your thoughts on app Lovin'? I didn't see the call. I only saw the top and bottom line numbers. I'd have to go through. Tanner's getting married twice this year. 1 to his fiance and 2 to Nebius. What's the right move from here? Yeah, but why would I let them get called away? Why would I let them get called away? If I had to go out super far where receiving that level of return becomes impossible, I completely, or becomes like super unfortunate, of course I would stop rolling. But if the roll can guarantee me 20% increase in the stock price, I still get premium, and I'm going out 2 months. Who's locking up 20% every 2 months? Like, that's just not that's not reasonable. You know, you can find it where your stock's 2x or 3x in short periods of time, but you can't bank on that. You can always roll down. Hang on. Okay, wait, 1 sec. 1 sec. I got to get my options expert on here. I'm just calling them. Not like they're busy or anything. Okay, they're not answering. It sounds like Tanner just clicks buttons. Black Mama, that's strike 2. Ever played baseball, brother? Because I haven't. Let's call Steven Fiorillo. Or no, Amit's an option seller. Hung up on me. Okay, let's see if I have any friends at all. Calling Steve the old reliable, he always answers. Steve. I've got Nebius is down 11.6%.
Okay, and?
It's $193.
Okay, and?
I've got a bunch of covered calls on this name for $300 strike all the way out to March.
So what are you asking? If you should buy them back?
Should I
write them?
Should I buy them back? Someone said that I should roll them down.
I mean, you could roll them down, but you could also do nothing and just be happy with the premium you collected. I mean, listen, if you want to get aggressive, you can either roll them down and try to make some additional money. And if it's close to that strike, roll them back out and up. You can definitely do that. Or you could just, let me ask you this. How much is it on a dollar price right now to buy them back?
It's like $4,300 a contract.
And what did you get paid on each contract?
I need to go back, but it was like it was something like $16 a share. So less than 4,000, I think.
Okay. So I wouldn't look, if you got paid $1,600 a contract and it cost you $4,000 to buy them back, I would not buy them back because there's no reason to.
Yeah.
That's just, you're losing money on that. There was no point even writing the contracts.
I know,
So
but
that concept's out the window.
I completely understand that looking past tense, that does not make sense. Like I would not sign up for that trade again. But is it good to guarantee that my shares don't go away at 300 by March? Like how much further than 300 does this stock go?
I mean, nobody knows. The stock could go to 80 by March, or it could go to 500. Nobody can answer that question. The question is, do you feel comfortable with the $300 protection? If you do and you want to get aggressive, you can roll them down a bit and try to make some extra money. The thing is, knowing what your situation is, why even mess around with it? For what, a couple $100?
What do you mean knowing my situation? What does that mean?
Well, I just, knowing that you are doing well, I don't think that you're doing this just to make a couple $100. Why add the stress? Let it be, let some theta decay roll off, let some time pass, and you get a couple of months out of this where it gets a little bit closer to March. Maybe that buyback price comes down where it makes sense. Or you can just wait 4 or 5 months, and let's say Nebius is at 250, you can roll them up and out again. I just think that there's no reason to do anything right now.
Yeah.
I mean, I'd have to really sit down with all the exact numbers and figure it out. But if you were to roll down and out, like, would you really even consider going to 230 or 240, knowing that Nebius can be there in 2 weeks?
No. I would
Exactly.
if I'm buying them back, I would just do it to hold the shares. I think this company's worth more than 300.
No. Don't think about it like that, because you still have $110 before your shares are even in danger.
Yeah.
Like, you're holding the shares regardless.
No, I know. The only reason why I was ever considering it is because the contracts are not worth $4,000. Like, dude, back whenever this was 300, the contracts were like $11,000.
Yeah, because they're going to go up.
Yeah. But no,
Well,
what
once
what you said makes sense. I honestly, I'm sold on what you said. I'm just gonna sit still.
Yeah, there's no reason, because even if shares go back to 300, you're not buying the contracts back. You're just going to roll them again. And also, don't give me a number, but what percentage
Like 40,
of your total share price is as cover calls?
probably like 40%, probably 40-50%.
Yeah, do nothing. Come back in 2 or 3 months. Do nothing. That's what I would do. Nothing at your point.
Thank you,
Like,
Steve.
I've been in this situation with NVIDIA. I rolled NVIDIA down. I rolled it up. I bought some back, but it made sense for me to buy some back because I had allowed so much time for them. So me, I would do nothing for a little bit.
That makes a lot of sense. Thank you.
Okay.
All
You're
right.
welcome.
See ya. No, see, Steve's right. I don't want to roll them down because I think that this company will be above 300 by March. So I don't want to bring like I don't have to play with it. I'm in the green 100%. I'm in the green on my shares. I don't want to sell. I don't want to get out. The only reason why I'm even looking to do anything with these is because I believe in the company long term. I believe it's worth more than $300. But I do have some time. I've got a ton of time to think about this. If I rolled them down, then I'm only getting myself into more of a sticky situation, earning more premium. But then if it flies back up, then I could get caught with this stock at 240, 250. I don't want that. Okay. Now call Chris. No, because I wanted an opinion on the actual sensible options decision, not on what they think about the stock. I don't care about other people's opinion about, or like, I'm not calling Steve about his opinion on Nebius. I call him about his opinion on what to do with the option. with the actual contract. That is important to me. But some people said that I was in hot water. I'm on the hook for anything. No, I'm selling these options. I'm not a buyer of any options. I've already gotten paid. The worst thing that can happen to me now is that Nebius either goes bankrupt and goes to zero, or well, I mean, it could collapse significantly, but I'm not looking to sell. Like, those are not the two options that I'm fighting with myself about. I want to be a long-term holder of this company. I want to be able to hold it into the $400s, $500s, $700 price ranges. Maybe it gets there over 18 months. You can see the explosive nature of this company. I worry that it's going to get there in quick succession after good earnings reports. That's my only fear. Is that I don't get to capture that upside, which is not necessarily a bad thing. Like, just, capping your upside sucks, but you're not in hot water. You don't lose any money from capping your upside. And now I've got a pretty good margin of safety here. Okay. 700. Well, I don't think that's going to be anytime soon. It needs to grow there. But I think that people drastically underestimate how big a company can get over a multi-year period. It would be like saying, hey, you're buying Nvidia at $20 and then going, hey, hopefully this company gets to the $200 range. You'd be like, what are you talking about? But I mean, the goal is to buy companies that compound over many years. Tanner, just figure out a way to shorten the contract. It increases your delta and theta decay. Yeah, but okay. Will I get paid on that though? I would get paid on that, right? Because it's a higher. Well, hold on. Let me see what happens whenever I roll these. If I go down, but it has to be the same date. I can't roll to an earlier date. Is that true? It can't be an earlier date, but it can be a much lower price. You can roll earlier. Got you. Got you. Wait, did you sell these calls at the lows? It was like, I sold them at like 130, something like that. So dude, I'm on like my 7th roll. But you're using hindsight to say what is the better thing to do. Like, oh my God, why did you do that? It was about to go to 300. No one called for that. Like, go back into your brain and remember what the heck happened. Okay? This thing was range bound for a year. And I was way out of the range. I mean, like, the delta was like 0.1. But whenever it triples in 2 months, 3 months, you quickly change your strategy. I promise you guys, I'm good. It's your third biggest position for a reason. If it was a trade, I'd understand. My third biggest position is SoFi, not Nebius. Yeah, it was months ago. I've been sitting on these contracts for a while, but I'm not in trouble at all. Like, you guys are acting like I'm in some sort of degen air. I'm not even remotely in trouble. I've got the stock has to go up like 50 something % before I'm even remotely in the red. And I'm not even in the red. You guys are driving me nuts. My average share price on Nebius is like $80 minus like the $16 that I've made on selling the contracts and making the premiums. Denial is the first phase. On no margin. It's all my own money. Tanner, I could send you food. Don't worry. I completely agree, Dougie, but I promise you, I'm going to roll again. If we start going that direction, you're going to see, like, it all depends on if, I feel like the only person I'm having a real conversation with here is Dougie. He's the only person that's actually getting what the heck I'm saying. But you're completely correct. Can I not look to do 400s by, May? I don't know. I'm still holding a $200 strike covered call for January. Had to roll around the same time you did, but didn't roll after that. Well, I mean, you're better than me. I didn't, I get nervous. Don't start pity donating. I don't. Oh my God. It is the funniest community. I mean, genuinely, I didn't get involved in finance YouTube to have this much fun, like in terms of like the humor aspect of it. But you guys are funny. Okay. Well, I'm glad that we covered that. Makes me feel better about my position. Steve always answers, no matter where we are. Now, as for Nebius, I have actually been adding to my position because I think that these are really good prices. My average is going up on these purchases. But yeah. Steve is a true friend, yeah. He really is. Sometimes he comes across as if every single word that I'm saying he doesn't want to hear in the moment. That can be hard sometimes. He's the type of guy that you call him and he answers with what? That's not, I would probably tell him if we're in a marriage council that he should look to change that. But aside from that, he treats me okay. Yeah, Bezos is selling a lot of Amazon right now, but not nearly as much as what people are doing to Nebius shares. Okay. We're making better intelligence easier to access in ChatGPT for everyone. ChatGPT 5.6 now powers both instant and deep reasoning for Plus and Pro users, delivering more factual and focused responses. Free and Go users get unlimited text chats with ChatGPT 5.6 Luna starting tomorrow. Wow. We're going from 5.5 to 5.6 on the the generally available chat. And that's probably likely because they're pushing out some of their new models already. This is the thing that ended up getting leaked most recently. OpenAI is now preparing for their launch of Astra imminently, targeting next week. This is their next major model. Astra is now is the new pre-train, their largest model OpenAI has ever trained since since GPT 4.5. So that's pretty exciting. Astra is the one that they met at the White House about, talking about how it's going to run multiple agents at the exact same time to tackle different parts of one problem. So leading to obviously much faster response times while also handling much more complex problems. Oil spiking. Oil is spiking. New high of the day, $78 a barrel. $78. Someone also asked me to check fear and greed. Let's check that as well. This is investor sentiment. We are in greed. A 60. Yesterday we closed at a 59. We're somehow even more greedy today, even though the NASDAQ and S&P 500 are both red today. Net new 52-week highs and lows on the New York Stock Exchange. We're actually in fear. Wow. Okay. CoreWeave has more upside from here than Nebius. I don't think it's as easy as that. I think there's, they're both going to do well, but they're tackling different customers. Honestly, it would be my dream to speak from somebody from CoreWeave and Nebius. I want to hear, similarly to what we did with oh my God, the chair is so squeaky. What we did with Chad would be great if we could speak to some engineers at the data centers. Austin with the 750 joules. Let him cook. I still don't know how much a joule is. I think it's a penny, right? Is that a $7.50 donation? Thank you, Austin. Appreciate it. I don't know why they made it into joules and not just... Did no one enjoy the dollars and cents? It's like doing the TikTok thing. Is memory cooked? That's a great question. So, yeah, we meant to cover that as well. We ended up seeing SanDisk show off their earnings yesterday, and a lot of analysts have really been recorrecting their price targets on SanDisk. A lot of lower prices. Still some, buy ratings. Some market outperforms. But we had someone recorrect. I think their price target before was like 3,000, and they brought it down to like 1,750. That's a very, very big difference. That was Jefferies, actually. Jefferies lowered their SanDisk price target from 3,000 to 1,750. Analysts said mixed print as strong June execution was offset by only an inline September guide. Investor focus will center on moderating prices, lower gross margin guidance, and whether edge inventory builds create a net headwind to bit growth. Okay. So what's called? Then there was this story that ended up coming out from NVIDIA. Something went wrong. Okay, there it goes. It's just trying to load the stock price. NVIDIA considers less high bandwidth memory for the Rubin Ultra GPU. So this is the one that comes after Vera Rubin. The Rubin Ultra is like their 6-month increase. So we get the Blackwell Ultra, Rubin Ultra, Feynman Ultra. NVIDIA is weighing a radical step to deal with a shortage of advanced high bandwidth memory chips, said the information. Well, if that's going to happen, then what happens to the Microns and the SanDisks of the world, where expectations for their overall growth was not just matched by increasing average selling price and more chips, but also the percentage of memory per chip. Micron seems not very phased, but maybe also because we're not at all-time highs either. Tanner, I want to apologies for last time I said you were corrupted by Noto. I don't believe that anymore because of your reaction, and I truly believe you are genuine. Keep up the good. Thank you, Adrian. What's the reason for the sell-off? Michael Burry shorted Nebius and Oracle. Yeah. Microsoft just hit 500? Not quite. So close. So close. Okay. Sorry, Spencer, I didn't even see you raining me with dollar bills. I thought you sent me one. There's like a ton here. Thanks. I didn't notice that. Okay. I kind of want to stick to 4 o'clock to see the actual reports. I also kind of want to freaking go. So I have to, I don't know. Should we get a guest on? Should we get a Gaston? Okay. Let's see. Who should we call up? Should we call up the Chris Patel? The great and powerful? Please cover AOI earnings report. Yeah. Chris Patel, no answer. I keep waking him up, I think. That's all right. All right, let's check CNBC then. We covered most of the stories of the day, I'm pretty sure. Now we're just waiting for earnings. Okay. Former New York Governor Andrew Cuomo, socialists will win, make it easier for Republicans. I don't care too much about that story. Western Digital shares drop. Are they still down? Where's Western Digital now? 12.7%. We went as low as $407. Oh my gosh. That's wild. Okay. Ladies and gentlemen, I'm going to be bored sitting here for the next 20 minutes waiting for earnings. If you guys want to see the earnings story, make sure you check out Amit's live stream. I'm going to get going now and get ready. Remember, tomorrow there is no live stream. I apologize. I am going to a bachelor party thing for the weekend, so I'm actually leaving tonight. I won't be streaming tomorrow. But thank you all for joining me. Please, if you could, in the pinned comments there in the live stream, follow the second channel. That's all I ask of you. You can see some of the live streams that we had, like with Amit or Roy or Chad that we just had today. Until next time, thank you all so much for watching. Really do appreciate your time. But bye for now.